Hello again, this is Robert Schein, Managing Director and Partner with Blanke Schein Wealth Management. Well, today is May 7th, 2020, and to our clients, friends, and family, we're committed to our daily updates for you. As it relates to market observations that we may have, insights, or anything that we see across the spectrum of the news in the financial economic world that potentially could be moving the market today or at some point in time in the future. We've been through a lot the last 45, 50, 60 days. In fact, the NASDAQ is teetering on turning positive for the year. Who would have thought? We have a lot of intervention from the Federal Reserve, the Fed balance sheet. I spoke about this in great length over the course of the last few weeks and months, if you will. And really what it is it's a concern in the future, but in the interim, what the market perceives as the market and the Federal Reserve, has been doing the proper thing. Now the Fed's balance sheet is, as a percentage to GDP, completely way out of sorts. But the Federal Reserve is strategically doing that on a proactive basis, we believe, to send a message to the market, all markets, credit markets, liquidity markets, money markets, municipal markets, that the Federal Reserve will be there. And clearly, this has been working as a strategy that the Fed is employing. Now, on a go-forward basis, the deficits that we're going to look at and the debt that we're going to look at, that's certainly going to weigh on the economy. That's certainly going to weigh on our growth possibilities on a go-forward basis. But we could worry about that tomorrow as we have to get through today. So essentially is what the market is really looking at and thinking about. Now, in the camp of there's always something to worry about, especially when it comes to investing. And honestly, if you actually listen to all the headlines without doing deep research, or believing in some companies that are well run, well positioned, and honestly have some pretty good competitive advantages relative to their customers, and ultimately can thrive in business environments even as challenging as these. If you bought into the headlines on a daily, weekly, or minute by minute basis, you would never invest. We believe that we're believing in America itself here at Blanke Schein Wealth Management. We believe in the American worker, and we also believe in the capital markets, especially over the long haul. I think time has shown that. Don't bet against America, as Warren Buffett has said. But that being said, let's look at the good, the bad, and the ugly today, which is our next topic. So let's look at it. We have three different categories, I think, basically to sum up the good, bad, and ugly. And the only thing right now, I think, in the good camp, if you will, are that interest rates are historic lows, right? We didn't think they could get lower to sort of the beginning of the year. We look at the 10-year Treasury. Historically, it's I couldn't imagine it being in this level right now. But as it relates to businesses, governments, Treasury debt rolling over, even mortgage sort of refinancing opportunities, that's a relief to the economy and sort of a backdrop right now that interest rates are low. So that's the only thing right now that's squarely in the good camp, if you will. The bad camp and then the ugly camp. I think I have two of them right here. On a neutral side, government deficit, that could be definitely in the negative camp, if you will, simply because of our deficits. But the markets at this moment don't think so, okay? And there's a lot of reasons for that. That's for a longer debate at this moment in time on a go-forward basis. But in present day, markets have this, at least by the research that we've done, that puts that into the government deficits camp in sort of a neutral stance. And simply because the United States and the dollar has been strong through this. And so we're the reserve currency, and as the world sort of it weakens through this, we're the strongest of all of that. So that sort of helps us even in the time where our debts are exploding. So that's a short answer there. Trade deficits, wage inflation, price inflation, all of that is sort of in the neutral category. The category really that, in no particular order right now, but we want to take note of the ugly is, non-residential construction, CapEx spending, manufacturing, the credit environment. That's a big one. Constantly looking at all the credits that I've been talking about, from investment grade to high yield. That's still being in the ugly category and something that we have to constantly keep track of. Unemployment, we know, is absolutely ugly, and then consumer spending, business confidence, consumer confidence, and ultimately housing. So those are all the good, bad, and ugly. And we're putting up on the dashboard, and constantly as we move through this together. There's a lot of economic sort of indicators that we have to keep track of. So that's that for right now. So last topic is I want to talk about the employment rate. So we're seeing headlines, and this is absolutely tragic, that on an unemployment, the unemployment claims right now is that essentially indicating that 1 in 5 Americans have claimed unemployment insurance. Never be seen before. In fact, Great Recession, Great Depression, we had high unemployment, but this is taking the cake right now. So it's sad, it's tragic, especially small businesses that may never reopen. So the economy is significantly impaired, in fact, as we discussed here on the previous topic. That being said, we want to find out if the programs, the government policies that are put in place weeks back, if they're working their way through it. And so, there's in the notes below this cited reference that I have from Homebase, actually. What's great about today's 21st century technology is that there's real economic data that is updated minute by minute and second by second. You just have to look at the sources and the websites to go there. That's what the market is actually doing, and that's why markets sort of are grinding their way higher through this process right now, because it's not looking at the unemployment rate, which is significantly high right now. It's looking at workers going back to work. Well, do we have that data? Yeah, Homebase actually looks at the data. If we go back to April 12th, it seems that was the heightened point in time of which the U.S. economy is completely shut down. Basically saying 75%, and it tracks average hourly workers that are actually working across the United States. On April 12th, 75% of the U.S. economy is absolutely shut down. Every single day they update those totals. And so since then, that total from 75% of the U.S. economy shut down has been gradually coming down. Now we're at 50%. Only 50% of the U.S. is really shut down, meaning people aren't actively back in the workspace. That trend is persistent and it's continuing. Now, there's always a relapse effect. There's always the resurgence of the COVID-19 virus. But at least the trend is our friend right now as Americans are trying to get back to work. And different states in California and New York haven't been hit as hard. And so those states are actually the ones that are actually getting back to work a little bit quicker than we will be here in California. So that's the unemployment rate that we're looking at. So people are actually getting back to work. And as states reopen, we're going to see more of this. And it's encouraging, but it's also, cautiously optimistic and frightening as well, because we don't know what this virus is going to do. So, thoughts and prayers to everybody. I know that if you need anything, we're here for you, but thanks for listening.